Hello, everyone. My name is Sean Sessel, and I'm here with Michael Finke, Professor of Wealth Management from the American College of Financial Services. This interview is sponsored by Savvly, the private market-driven social security of the future. And with that said, let's dive in. So, Michael, I actually just read an article that Dario sent me the other day, Dario being the CEO of Savvly. He was mentioning you had a article that you wrote with Dave Blanchett, who's been on these calls before, kind of an open letter to Dave Ramsey. So I'd love for you to kind of give us some background on that. I know Dave Ramsey is very popular in the financial coaching world, and you took some exception with some of his recommendations. So I would love to hear you elaborate for our audience.
Well, I mean, he called me a super nerd goober, which, it's well, you kind of have to respond. So Dave Ramsey, like a lot of people, they haven't spent a whole lot of time thinking about this whole retirement income planning process. How do you create a lifestyle from a traditional investment portfolio? And his logic was, well, if I just invest in good mutual funds and I earn 12% per year, and I withdraw 8% from that 12%, then I should have money left over to then increase the amount of money I spend next year by the rate of inflation. So, well, that doesn't make any sense that it should be 4% that you can withdraw safely from an investment portfolio when you're getting 12% from stocks. And one of the things he was advocating is, well, of course, everybody should be investing in stocks because they provide a higher return. They provide a 12% return as opposed to maybe the 4 or 5% that you're going to get from bonds these days. So why would any moron invest in bonds? You should just invest in stocks so you can get a higher return. And then that'll allow you to withdraw conservatively, well, 8%, maybe 7% if you're more risk averse. That was his logic. That was his mathematical logic of why you should be able, why the 4% rule was just created by super nerd goobers who just want to destroy people's confidence about whether or not they have enough money saved for retirement. So we said, well, wait a minute, you can't just get 12% per return every year from stock investments. They're stocks. They bounce around a lot. They have a higher, for those of us who are super nerds, they have a higher standard deviation, which means that sometimes they go up and sometimes they go down. And the problem with retirement income planning is, how do you deal with an investment portfolio that is volatile and then try to withdraw an income that is not as volatile? And if you think about them, the more volatile the portfolio, the lower the income can be if you want it to be not volatile. And that's part of a much broader conversation about how do you create something that looks like a stable income from a volatile investment portfolio in retirement. There's two approaches, basically. You can either be very conservative and you can account for the fact that if your portfolio goes from, one of the big problems with investing and taking investment risk is that there is a normal distribution of portfolio outcomes. So you get lucky and you could have a 30% return on your portfolio, and you get unlucky and have a negative 20% return on your portfolio, especially if you're taking a lot of risk. And you have to live with the consequences of either a potential outcome. And if it's bad, then the consequences are pretty bad. So let's imagine that you're following a 3% rule. You have $1 million, you want to take out $30,000 per year plus inflation. You might have a 94% chance that you're not going to run out of money. But if you get a negative 30% return the first year of retirement, then you go from a 94% chance of success down to a 48% chance that you can then withdraw $30,000 from $1 million portfolio and increase that by the rate of inflation. That's the downside of taking risk, is that if none of us knows which cards we're going to get dealt after retirement. And so if we pick them up one at a time, we have to be able to live with the consequences of whatever the card is that we pick up. And if we pick up that negative 30% card, which, if you think about retirees who decided that they'd hit $1 million in savings at the end of 2021, and then they decided also that they weren't getting enough return on their bond investments, so they were going to invest in high yield bonds or long-term bonds or a lot of money in equities, and maybe they're going to put 10% of their portfolio in crypto. They picked up the negative 30% card in 2022. And the consequences are that the withdrawal that they thought that they could take safely from their investment portfolio is no longer safe. So they have to adjust. And that adjustment part is something that Dave Ramsey did not account for. What happens when you pick up the wrong card in retirement? You have to adjust your spending downward. If I went from $1 million to $800,000, am I going to have to go from $80,000 a year down to $64,000 a year, or even less if you're actually going to be somewhat cautious? The need to be flexible has to be part of the retirement income planning process, because otherwise you're trying to fit a fixed spending peg into the wrong hole. Like, you're taking your investments, putting them in variable things, while at the same time trying to pull out to extract something that's fixed from it. That doesn't work very well unless you're very conservative.
Yeah. So just as a financial advisor myself, and having been in this industry, when I read his logic, I was like, oh no, he's forgetting. And then you immediately went in and addressed the two things that were on my mind of what he was forgetting. The first being sequence of returns risk. Right. So if you withdraw on a smaller base, it's a larger fraction of a smaller base, and it disproportionately affects your return stream down the line. I know this because when I was back at Tectonic working because I was director of quantitative research. So I guess that makes me a super nerd too, because I'm sitting there with my math.
Exclusive club.
What'd you say?
It's an exclusive club.
Yeah. But my boss had me model what happens if the Great Depression happens in this thing.
Mm-hmm.
And it's very different if you have Great Depression and then 40s and 50s versus if you have roaring 20s and then Great Depression and then 40s. It's dramatically different because of that drawdown on that smaller base, because you don't get to keep all your money in the game when you're taking an income. Right. It's like somebody in Vegas trying to play a martingale, but having to take money off the table.
Right.
A martingale is the thing where you just do double or nothing until you get back to even, which of course, there's a tail risk that doesn't work out. It's net, not profitable. That's Las Vegas wasn't built on winners. And for many people in how they handle investments, they can almost approach it with the same mentality at times. And if you don't take into account all that mathematics, right, which would be the equivalent of playing advantage in Vegas, then you end up in trouble, which gets us to the second mathematical point, which is geometric versus arithmetic returns. So if you have a 50% down year and then you have a 50% up year, you're not back to even. You're at 75%.
And the bigger the difference, the bigger the loss, the more you have to make up.
Exactly. Yeah. Again, it's not even linear. It geometric means it goes like that, right? In that kind of hockey stick thing. So your points there in that article were in my mind exactly spot on of why that approach doesn't work. And so if somebody's in, this is a little bit of a tangent, but this is something I've been thinking about, right? 2022 was a rough year for investors. 2023 has obviously been a lot better. I don't know what's going to happen in the next couple of years. I do know that we've had a yield curve inversion without a significant recession.
Yeah.
I do know that where we are in the Fed tightening cycle, normally, the low point is about, on average, 12 months after the Fed starts cutting, which we're not even to. So I the next 5 years could be, could be down years. I don't know. I have no idea.
Yeah, right? The thing is, nobody knows. So, and you can invent all sorts of scenarios about, why the market is going to be flat, why it's going to go up, why it's going to go down. I tend to, in my prior research, I also focus on things like valuations. So, stocks are pretty expensive right now compared to historical valuation.
It's pretty high.
And
for the audience, cyclically adjusted price to earnings ratio.
Right. So in other words, how much are you paying for $1 of profit? And the example I always used to give in class is, if you're going to buy, say, a dry cleaner, and the dry cleaner brings in $100,000 of profit, after you pay for all the employees, what would you pay for that dry cleaning company? Would you pay $1.5 million for $100,000 of profit? That seems about fair, maybe a little bit high. That's
the 15x multiple. That's a little bit high for private acquisition.
That's how much historically investors were willing to pay for $100,000 of profit in the S&P 500. So they would be willing to pay about $1.5 million for every $100,000 of profit. Today, it's over $3 million. Now, do you expect that the return on your investment in the long term is going to be better if you pay $1.5 million for the dry cleaner, or if you pay $3 million for the dry cleaner? Generally speaking, if you pay more, the expected return is going to be less. And in fact, historically, that's exactly what has happened with stock returns. When you look at 10-year returns, the price of profits today is a really good predictor of how well they're going to perform over the next decade. And stocks have been expensive for a while now. Like, they had a dip back in early 2020, but generally speaking, they haven't been close to the historical average for a while. So I think one of the things we need to do is dampen investors' expectations about what's known as the risk premium they're going to get for investing in stocks as opposed to investing in bonds. And honestly, I think when the 10 years hit above 5% recently, my money on the 10-year performance probably would have been on 10-year treasuries versus 10-year S&P 500. It's nobody knows what's going to happen, but generally speaking, you can expect that when equities are expensive as they are right now, the expected return is probably going to be somewhere in that 5 to 7% range on average, but it could be less.
Yeah, I was going to say my bet would be on 10 years of equities versus 10 years of bonds, but with a lot of volatility on the equities, which, again, if you're retiring and you're withdrawing an income, the sequence of returns actually makes that worse.
Right. And you have to remember the difference between arithmetic and geometric returns. It means like how much money do you have after the decade? And, there was a point when stocks got really expensive back in the late 1990s and early 2000s where, I got my first job where I was contributing to my 401k in late 2008. And pretty much every dollar I put into my 401k into equities between the early 1999 at the end of 2000, I did not get my money back over the course of 10 years. In other words, if I had invested in the S&P 500 over the next 10 years, I did not get back to where I started. So I actually got a negative geometric return on my equity investments over the course of that decade. And that was exactly what valuations would have predicted, is that I'd be lucky to tread water, which is exactly what happened.
Yep. So here's the thing that I'm thinking about, right? We had a record number of retirements in 2021, right? As stock portfolios rocketed,
right,
with loose monetary policy and everything. So much so that it created a dramatic and seemingly permanent decrease in the labor force. And so that raises the question, if somebody retired in late 2021, then their first year was last year, 2022, which wasn't a good year. So they're starting off on a bad sequence of returns. This year is better, but let's say over the next 5 or 10 years it underperforms. Their expectations versus what they're actually going to have for their retirement, especially if they're all or primarily in equities, as was recommended by Dave Ramsey in that article, is not looking great. So like, what options do they have? My thought is that people are going to have to unretire some of them, go back to work. They can try to take riskier options, but that's the same thing as the double or nothing at Vegas. Eventually you get cleaned out if you're not careful. What are the options for someone in that position?
I don't know. I've got no good advice. I gave presentations on retirement income planning at the end of 2021, and I try to reiterate, like, this is probably the most expensive time to retire that I've ever seen. There was a point where in a 50-50 portfolio of 10-year treasuries in the S&P 500, you needed to have over $80,000 of portfolio value to generate $1,000 of income, either from yield on the treasuries and from yield on the S&P 500. So in other words, they were both so expensive that it took over $80,000 of portfolio wealth to generate $1,000 of income. That was about 4 times what it was in, say, 1994. And, the idea that anybody could generate the same amount of income from that expensive of a portfolio just seemed wrong to me. I just wanted to warn people, like, I know you met the threshold. I know you have $1 million and you've always wanted to have it. You always said that you'd retire if you had $1 million. Well, that $1 million is not going to buy you what you thought it was going to buy you. It doesn't mean the same thing as it did in the 1990s, because simply the market is not rewarding investors as much as it did back then. Now, we've had a little bit of reversion when it comes to bond returns. Yields have gone up. That means the cost of retirement is significantly cheaper now than it was back in the end of 2021. But still, things are expensive. Even now that things have corrected a bit, they're still expensive.
Yep. So I think, as we talk about, not going with the all equity strategy, because there are a lot of risks inherent, it gets us into the topic of, what you do for growth and what you do versus protection. Because there's a big difference between what's the long-term average, right? Especially if you adjust for valuations, and what's the bedrock that's going to sustain someone in retirement. So perhaps we can share with our audiences, how do you think about that trade-off?
Yeah, one of the ways that I think about retirement income planning is that you have to, first of all, acknowledge that your spending is going to be flexible. If you take any sort of investment risk, you have to be willing to cut back if the markets don't give you what you want. Now, if the markets do give you what you want, and they give you better than what you want, you can be flexible and spend more. But right now, I think that it's best to focus, first of all, most defined contribution workers now do not have a pension. So you've got your Social Security, that is your base of lifestyle. All retirees have inflexible expenses on top of Social Security, especially upper middle class. The kind of retirees are the ones that actually have to worry about retirement income planning. So they're the ones that have saved a decent amount of money for retirement. They're the ones that cannot replace their lifestyle through Social Security. They're going to have to take a slice of their savings and buy enough income to be able to provide a flow of cash that is going to pay for all their basic inflexible expenses. You've got to take care of that. And the idea that you can cover that expense with equities is ignoring the fact that risk is real. And risk means the possibility of potentially having to cut back. And when you're putting together a portfolio strategy, it's really all about how much flexibility of income are you willing to accept. So when you take greater risk, it means that you can live better, but there's also a possibility that you're going to have to live worse. And some people can be more flexible. For example, if I had a pension, then I would have my Social Security, I'd have a pension. The consequences of a negative market are not as severe for me. If I have to cut back on my flexible spending, I can do it because I have enough to cover my basic expenses. With no pension, I don't have the same amount of flexibility. Now, if I'm doing that, I can either do it with bonds. I can create what's known as a bond ladder, and I can fund those basic expenses every year by putting together a strategy where my investments mature and provide exactly the amount of money that I need to fund those basic expenses. Or I can try pooling that risk with other retirees and potentially get to spend more money.
Okay, yeah. So let's talk about that, because when you talk about pooling the risk, what are the different options people have for that, and how do you think about that?
Okay, so I'm going to tell you a story. Imagine that you're having a birthday party. It's your son's birthday, and your spouse phones you up and says, "Hey, I'm not going to make it home from work, but there's a birthday cake in the refrigerator, and there's going to be somewhere between 5 and 40 kids that are going to show up for the birthday party." By the way, on average, there's going to be 20 kids. You take the birthday cake out of the fridge, and then the first kid walks through the door, and you have to decide how big of a slice of the birthday cake to give that first kid. Now, when you're thinking about this, you're thinking, all right, what's going to happen if the 35th kid comes through the door and I'm out of cake? They're not going to get any birthday cake. They're going to be really disappointed. They're going to tell their parents, I'm not going to get invited to any more barbecues in the neighborhood. So I am going to cut the cake into very small pieces to make sure that every kid gets a slice of cake. Now, what I'm doing is I'm accepting an idiosyncratic risk. The idiosyncratic risk is not knowing how many kids are going to walk through the door to come to the birthday party, somewhere between 5 and 40. What if I had a bakery that was willing to make me a deal? I pay a little bit more for the birthday cake, but if more than 20 kids come in, then they'll show up with a second birthday cake. So I can cut the first birthday cake into 20 slices. And then if the 21st kid comes in, I can again cut the second birthday cake into 20 slices. Every kid gets a bigger slice of cake, and I don't have to worry about potentially running out. Now, it seems like that I'm getting something for nothing. And in fact, I am. When I get rid of an idiosyncratic risk, then I am getting the ability to, in this case, cut bigger slices of birthday cake. In retirement, I can spend more money from the portion of my investments that I was dedicating to funding and income. I can spend more money every year if I delegate that idiosyncratic risk to someone else, if I pool it essentially with other retirees. Another example of this is, imagine that you are creating a bond ladder. You're a 65-year-old healthy male. You're creating a bond ladder up to the age of 100. Now, you're risk averse. You still have a 5% chance of running out, of outliving your savings. And let's say that you want $15,000 of income per year. Today, you would have to invest
15,000 per year from the bonds, or 15,000 per month?
15,000 per year from the bonds, just as an example.
So you've got other stuff there.
I got other stuff.
Okay.
So I'm just going to create a base of income on top of Social Security to cover my property taxes and basic expenses. And let's say I wanted to cover $15,000 of spending at the age of 97. I would have to save $5,000 today. I can buy, let's say, a zero coupon 30-year treasury that is going to mature and provide me with $15,000 of income at the age of 97. Now, what if instead I got together with 9 of my 65-year-old male friends, and instead of each of us having to set aside $5,000 from our retirement savings to cover $15,000 of spending at the age of 97, we can create a long life income club. And what the Long Life Income Club allows us to do is pool our money together. So instead of each of us having to set aside $5,000, we can each set aside $500. We all chip it in. And whichever one of us is still alive at the age of 97 gets the full $15,000. And all they had to do was chip in $500. Now, why would you want to be part of the Long Life Income Club? Because you would have an extra $4,500 to spend every year in retirement, and you wouldn't have to worry about running out. So you can take that $4,500 a year and you can spend it on fun stuff. And that's a better way to live. You've delegated that risk of not knowing how long you're going to live to the pool. Now, some people get really caught up on the fact that your internal rate of return on becoming part of the Long Life Income Club would not be as high if you died at, say, age 80. But the reality is that every year you were alive, you got to spend more money. And you worried less about potentially running out. And you don't care too much about what your IRR was when you're dead. So you've essentially transferred that risk to the pool. You can spend more, you can worry less. And it's one of the reasons why economists say that there is an annuitization puzzle. In other words, if you can pool the risk of not knowing how long you're going to live in retirement, why don't people do that? And I think one of the reasons is because they just don't understand the benefit that they can get. To me, the benefit is being able to spend more. That's a pretty good benefit. But one of the problems also is that I think people have not acknowledged that there's only 2 places your money can go when you retire. It can either get passed on to someone else, or you can spend it. There's no third option. So people oftentimes, they fall in love with the amount of money that they have at retirement, with the portfolio value, and then they try to have more money by the time they're 90 years old. But what does that mean? Well, that just means you're giving more money to your kids. And if that's what you want, then great. But if that's not what you want, then you need to actually develop a more deliberate plan about how to spend that money down. And pooling then all of a sudden allows you to spend more from the amount of money that you've saved.
Yeah, there are a couple of things there. I think, there are 2 mentalities that would kind of cause people to go into that hoarding thing that you described. One is a fear-based mentality, where, and these are the people who you'd say, hey, listen, here's your long life investment club. But what if everybody lives to 97? And it's like, the odds of that are very small, but like that kind of like very, 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 very risk averse mentality is certainly a non-trivial thing. And then the other mentality would be, as you said, the ones who they just get into optimizing the finances of it and just like, how can I maximize this number, right? And it becomes almost like a game to them.
Yeah.
So
yeah, and it's a misunderstanding of why you pool risk in general. Insurance is the way traditionally that people pool risk. And any form of insurance is not going to be wealth maximizing. So if you acknowledge that, then it's easier to understand why you buy insurance. You pool risk so that you can get rid of the possibility that you have to live with the worst potential outcome. Yeah. When it comes to retirement income, the worst potential outcome is A, you don't get the investment returns that you'd hope for, and B, you live too long. That's not really a bad thing, but the risk is that you potentially deplete your financial resources if you're living well, or you can choose not to live well. And in that case, you have preserved your assets, but at what cost? You basically wasted the last 25 or 30 years of your life because you've not actually had fun. And the consequence is that you pass the money on to your kids. And, if they're the kind of people who spend money, then they'll have fun with it. I've done research on kids that receive inheritances, and you can pretty much categorize them as either ants or grasshoppers. The ants, it'll take them on average about 500 years to spend the money that they receive in an inheritance. And the grasshoppers, a little less than 4 years. So if you don't spend the money that you earned during your retirement and you pass it on to a grasshopper, they will have fun with it and it will be gone in 4 years.
I can't imagine spending an inheritance in 4 years. I guess that makes me an ant.
Yeah, but grasshoppers that would spend it in 4 years.
Okay, yes.
No
well, okay. If I think of the person who's would most consider a grasshopper, I don't think he could spend the money in 4 years just because his parents have so much money. I think it would take him at least 10, but it would get spent.
I do think that there are a pretty good number of grasshoppers who are children of rich people.
Yeah. I don't know. I mean, who knows? Maybe somebody could spend that much in 4 years. I think that would it would be. I can't conceive of how one would spend that much money in 4 years. But I guess that makes me an ant.
It does. Yes, we're both ants.
So
nerd and goobers.
I'm sorry, what?
So we're super nerd ant goobers.
Oh, okay, got it. Going back to Dave Ramsey's quote. Okay, so if we're thinking about this whole pooling risk for mortality thing, I agree with you that the two things that you want to avoid are, not living well in retirement, or on the other side, running out of money. Because if you're 93 and you're still doing fine health-wise and you run out of money and then you have to shift to just living on Social Security, that's not a good way to end things.
Correct.
So I think those are the two tail risks that really matter. And it's kind of it's an asymmetric risk return, right?
Mm-hmm.
So it's not just about maximizing the money and getting the maximum EV. The question, EV being expected value, the question is, what do you get out of it in terms of quality of life? And that doesn't necessarily map one-to-one with dollars.
Well, it doesn't necessarily. And I think that retirement income planning is more than just, a numbers game. Numbers are just dots on a computer screen. They're just, green paper. They don't mean anything. And part of the research I've done on life satisfaction really shows that money is an input. And, it's if there are really three predictors of life satisfaction. There are relationships, there's health, and there's money. And really, you have to combine all three of those to generate happiness. But money matters. Like, money gives you access to being able to do stuff. But, and there's also this realization that money can actually mean more when you're younger. And if you fail to spend it when you're younger, you miss out on being able to go on vacations when you're the healthiest. And we can really enjoy every dollar more than you can at the age of 93. I mean, it's a tragedy if you start having to cut back at the age of 93, but you're not doing a whole lot else, other than spending money on healthcare and a few other things. But when you're younger, that's when you could really enjoy the money. And doing something like pooling longevity risk gives you the license to be able to spend that money earlier, as opposed to conserving it to protect against the possibility that you're going to run out.
Yeah, which gets us back to, I think we've made a strong argument against the, hey, I want to maximize the number of dollars in the bank. I think then that gets us back to that other mentality, which is the fear that your long life club all lives a really long time. And this is one people have actually brought up to me a lot. And I don't think people recognize how reliable that actuarial data is when you're at scale. If you're dealing with, say, an annuity from an insurance company, the amount of people that have paid into that insurance company, it's not 10 people who might live to 97. The odds of a significant deviation from the tables is infinitesimally low, barring a societal shift in longevity.
Right. I mean, nobody knows this stuff better than insurance companies and actuaries. I mean, the fact that not everybody is an actuary, probably a good thing. They're not that much fun at parties, but I love actuaries generally. But everybody can invent reasons to imagine a worst case scenario, but something like longevity and more, looking at a mortality curve, we can be pretty darn confident that a mortality distribution is going to look like what we project. Maybe you're right. It may be a little bit infinitesimally different, but we've been looking at mortality statistics for over a century now in the United States, and there's this slight creep upward, or there has been this slight creep upward in longevity over the course of the 20th century, and we've had some pretty amazing medical advances over the course of that time, but still doesn't move the needle all that much. So it is a very unlikely event that that's going to happen, as opposed to a very likely event that you're not going to enjoy the money that you spend if you don't pool mortality risk.
Yeah, I think the only way that we see the actuarial tables break in the way that people are afraid of is, we have had some longevity doctors come on for these interviews, and two of them have said that it's not unrealistic that we crack aging entirely and that people are living to 150 or more, right? And if that happens, I mean, you have a fundamental shift in society such that the whole concept of retirement goes away, right? So you're either in a situation where the tables work, or all of society has to reconfigure for, indefinite life without old age, which, that would be fascinating and interesting. But if that happens, then your financial plan is worthless anyway.
Yeah, if people don't age, then they can work longer. Mm-hmm. I don't know. The thing is, it's fun to talk about, but do we actually, with all the advances we've seen in medical science and, understanding all the things that can kill us, have we actually seen a structural break in that gradual improvement in mortality over time? No, it's almost, it's creepy how consistent it's been over the course of the 20th century. We've gained about a year in longevity every decade over the course of the 20th century across the world. It doesn't matter what country you're in, all of the advanced countries are gaining slowly longevity. In the United States, we continue to gain among those who have enough money to worry about this problem. So in the United States, actually, what we've seen is a big break between how long higher income people live and how long lower income people live in the United States. There's a big dichotomy, but higher income people continue to make gains in longevity, but it's just not happening at that high of a rate. And, where are you going to bet? Now I could get really super nerdy here and say, if you really think that's going to happen, you can invest in these sort of longevity swaps where you take the risk off of the insurance company's balance sheet by essentially betting that people are going to live longer than you expect them to live. But, those seem to be priced as if people are not going to live that much longer than people expect them to live. So the market doesn't think that there's going to be this huge.
The market, yeah. So we did, when we did the interview with, we had a leading longevity doctor who runs a clinic that, multiple billionaire clients can reliably turn people's biological age back 10 to 15 years. And then we had David Blanchett, who who's in the financial services thing. And David, who would represent kind of the prevailing market opinion, his comment was that he just could not see that what the doctor was saying could happen, right? So there's a big gap between, as you say, the market and the insurance companies and finances versus some, and I want to specify that's only some leading longevity scientists. But I think that if what they said is anywhere close to correct, then you end up in a situation where the whole concept, because like I feel like most people, they work to retire, they work with this aim. Okay, I want to get to the end, I want to retire, and I want to live well in retirement. And they do something that they don't really, or they may or may not really enjoy, but they want to be done with it. They want to retire. I think if you don't have that, structured in there, or if the time of working gets a lot longer, I think you see people moving more into jobs and careers that like they really that's kind of like a passion based, alignment based thing. Because otherwise, no, like if people are living to 300, there's a difference between working 40 years so you can retire and working 400 years, So I think that the whole structure of society would have to change, and there's going to be such adaptation that it would be radically different in that scenario. And so I think you plan for the scenario you have, and then you just keep awareness of what might happen, and if that happens, then adjust accordingly.
Yeah, and the 1 in 1,000 chance that people see a rapid improvement in longevity because they're not experiencing the same physical and cognitive decline that they would normally do, then your out is that you can now, because you're not experiencing the same physical and cognitive decline, you can now work more. But
right.
Retirement. So it doesn't seem like that big of a risk to me. But I think the bigger risk,
exactly. There's not a downside. Like people see the people who are worried about that happening, it's not a risk because then you just adapt. Like you get such a large benefit from the physical and cognitive rejuvenation that it pays off. And then your future earning power goes up enough that it's not a problem. My boss at Tectonic used to tell me, he said, Sean, I promise you, for someone with your skills and someone at your age, because I was at the time I was 26. He said, your greatest asset, I assure you, he said, I don't care what you own, it's your future earning power.
Yeah.
True.
It is. Yeah. We can have a whole conversation about human capital and how do you incorporate that into investment planning. One of the points I also want to make is that this idea of potentially living forever is naturally appealing to human beings. Sure. Because we hate to acknowledge the reality of our own mortality.
Sure. I mean, even if you turn off aging, you're still going to die eventually.
Well, yeah,
and a plane crash or a snake bite or who knows, like something will get you.
And I think the failure to acknowledge your own mortality is a big problem in the retirement planning process, because it's one of the reasons why people want to preserve their assets. They want to feel like they're going to last forever. They don't do, the right estate planning because they just don't know, they don't realize that they don't want to devote any cognitive effort to any task that requires that you acknowledge that you're not going to live forever.
Are you familiar with Memento Mori by Marcus Aurelius?
No.
So Roman Emperor Marcus Aurelius, philosopher as well. Uh-huh. So keep in mind, this was the most powerful man in the world at the time by a huge margin. He had one slave whose only job was whenever like things were really great and he was on the parade because like they just conquered something or whatever, was the slave's job was to tell him Memento Mori, which is remember that you will die. Right. And because he always wanted to keep death close at hand.
Oh,
that's a philosophy I've adopted. I think about my own death on at least a weekly basis.
Yeah.
And it sounds horribly like grim and gruesome, but it's not. It's just being comfortable with reality.
Yeah, I think that's, every aspect of the financial planning and even the life planning process is enhanced by willingness to acknowledge that you're not going to live forever. And also willingness to acknowledge that we all naturally experience a physical and cognitive decline in our old age. Now, if you think about the average, let's say you're a healthy 65-year-old man. If you look at your entire lifespan, 88 is the median. So basically what you get is 8 rows of 10 dots and 1 row of 8 dots. Each of them represent a year of your average expected lifespan. And if you retire at 65, you've got 2 rows of 10 dots and 1 row of 3 dots. So you've got 23 dots. That's all you've got on average. If you retire at 65, if you retire at 70, it's 1 row of 10 dots, 1 row of 8 dots. So that's the remainder of your expected life. That really changes your perspective, because it means that it's finite. Like if this was a game and I had 2 rows of 10 dots and 1 row of 3 dots, and I had a certain amount of money, what dot would I put my stack of cash on? So if I retire at 65, how much of my cash would I put on year 65? How much would I put on 70? How much would I put on 85? And essentially that's what you've got. You've got 2 rows of 10 dots, 1 row of 3 dots. You've got a limited amount of cash. You've got to lay your cash on each one of those dots. To do it effectively, that's how an economist would think about it. Like you want to cash the check to the undertaker. Now, the only way to do that in a risk-free fashion is to also pool longevity risk, pool the risk that you might have an extra 7 dots. So if you can pool that risk of having an extra 7 dots, that allows you to lay your dollars on each one of those dots and not fear the possibility that you could outlive your savings.
Yep. No, I agree. I agree with that. Right. And unless and until, we get these, massive medical breakthroughs, then the only rational approach then to get both the protection and the growth and the lifestyle would be to use some kind of pooling technique.
Correct. Yeah, I think people who had pensions, they would benefit from that. They didn't have to worry about the possibility of running out. Economists think that that's the most efficient way to generate income from savings. It's just that we've got to now rethink as a society, what are our options for pooling longevity risk? Because it really is the only way to live better from the amount of money that we've saved. Like this whole idea of investing in good mutual funds and getting 12% per year is not a good retirement plan. Pooling that risk of longevity and building a portfolio that balances the risk of equities and bonds, that's going to generate a much more consistent income for you.
Yep, absolutely. And, of course, that's something that we at Savvly are well aware of and a problem that we are certainly involved in helping to solve. Michael, anything else you want to toss in there before we conclude?
No, it's been a great conversation. I'm always happy to talk about this idea of retirement income planning. And I think this concept of risk pooling is one that oftentimes we don't give enough thought to. It is the only way to get something extra from our savings. You can either take investment risk, which is uncertain, or you can pool longevity risk and get greater spending with greater certainty. So it's great to have an opportunity to talk about one of my favorite topics.
Yep. I think that's kind of almost a common denominator in finance, is that, there's some rare cases where you can get alpha, but most of the free lunch is going to come from somehow crossing risks against each other, just like you do in a portfolio with, things that go in different directions to kind of get to the efficient frontier. Anytime you can cancel out risk against something else, that's normally a positive thing to do. So I certainly agree with that.
Right.
So cool. All right. Thank you so much, Michael. It's been wonderful.
Pleasure.
Again, this was sponsored by Savvly, the private market-driven Social Security of the future. Expect us to have more of these interviews. We've been bringing on thought leaders to help you better understand longevity and retirement, and we will keep on doing so. So thank you so much, Michael.
All right. Thank you.